the global market and where you see some of the best opportunities for equity investors today.
Certainly. So Chris perfectly set me up for this, alluding to what we are seeing as global synchronous growth. So this is not simply driven by US economic strength. It is also driven by strong economic data coming out of emerging markets, strengthening or perhaps stabilizing data coming out of Europe. And ultimately, we see this as a really constructive backdrop for equity markets more broadly. That's the politically correct answer. On the more kind of focused answer, I think today we are very overweight US. We see US despite having had a number of years of strong growth from equity markets, we see persistent earnings growth coming through. And not only persistent earnings growth, but persistent earnings growth with the ability to actually diversify, given that a lot of these companies are operating not simply in the US, but also in emerging markets, in Europe. So on the US side, we are, like I say, overweight. We are pro the US equity markets at this point in the cycle. That is certainly not necessarily the same as a number of our peers. A number of our peers today see US markets as being overtly stretched. But given, like I say, this backdrop, particularly we have had the positive impact from tax reform. We've also had a positive impact from the future fiscal spending from the government, all of this combining to really provide a very strong environment for the US equity market. You turn to Europe, and it is, from our perspective, quite a different story. So, although we have seen stabilizing data come out of Europe, we are not yet in an environment where we're seeing persistent earnings growth. So we're not yet seeing those returns come through, and therefore we see that as being somewhat, let's say, fragile today. So potentially downside risk within your European equity exposure. And then finally, in emerging markets in Asia, today, like I mentioned, we're seeing really strong, robust, consistent data coming out of China. And with that in mind, we are very much overweight the Asia equity story in our portfolios as well. Now, the background there is very much China as opposed to broad Asia. We see some risks, particularly geopolitical risks, elsewhere within that region. But from a structural or, let's say, secular growth perspective, we're only seeing that country continue to develop. We are only seeing new markets expanding, new companies entering that region. And what that is really providing is an exciting stock picking opportunity from our perspective as active equity managers. And I think that's a really key point that I would finish on, is that we think it's really important to be active when you're looking at the Asia, China, emerging market space. Because simply there are such a wide-ranging spectrum of outcomes across these countries that come with their own kind of inherent idiosyncratic risks, that ultimately we think you really need someone who is delving into the detail, delving into the ins and outs of these companies in order to understand what is the driver of returns that ultimately you will benefit from. So in summary, neutral Europe today, overweight Asia emerging markets with a focus on China, and overweight US equities.
I'll come back to